Hello and welcome back to Federal Income Tax for the Individual, where we're bringing you the awesome stuff that we can only do in this course. Now, this again is your host, Professor Naragon. Sorry for the late video. Was caught in a car accident and kind of has thrown off my time. But I want to get this to you. And this is cool. This is chapter 7, which brings in probably items that y'all have heard about when it's related to taxes, when we're dealing with credits, especially the big three: the child tax credit, the earned income credit, and our various education credits. Because you go to school, you get credit. I mean, that's one of the important things for y'all, right? So, we're going to be looking in those, trying to get those for y'all. The biggest thing that we got is also known the difference between credits and deductions. We've been working mostly with deductions throughout this course so far, but credit in itself is going to directly reduce your tax liability. And tax liability is really the taxes you owe. These help basically lower the amount, and they're really targeted to certain groups. When it says that, it's mostly people with kids, if it's child tax, earned income and certain income levels and ages, education credits, of course, people going to school. So it affects certain ones, and it wants to provide basically an equal benefit. So they are strictly done by rules and numbers, and nothing really influences. It's a strict limit. A deduction, though, is that reduction of taxable income, or basically deducting from our gross income. The problem with these is that they're still multiplied by your tax rate. So they do reduce the liability, but because they're more close to the tax rate and tax benefit, deductions still favor higher income individuals over other people. Well, again, credits do not. Okay? So when you're going through this PowerPoint, again, I would say look at the book. The book helps out, and also go into IRS website if you want to look at the forms and instructions. I know sometimes it's boring to read instructions, but it really does provide out a lot more flesh of the info than what the book and these videos give if you want to just take that extra time. Now, the first of the big three that we want to talk about is known as the child tax credit, which is right here. Now, the child tax credit in itself really helps out people that do have kids. It's a credit for any child that's under the age of 17 that is a dependent of that person. And we get what is about $2,000 in credit. Before the TCJA, before the new law, that was only like $1,000. So it's a nice increase for those who lost that personal exemption that had a lot of kids, and it kind of hurt them there with losing the personal exemption. This is supposed to help kind of cover a little bit more. Does it really? Well, I mean, if you're a part of a family, you notice that it probably did not a lot, but it does try. Now, you have to remember, qualified child, again, they have to live with you for more than half the year. You have to provide half of their support. All this that we've learned in prior chapters. The only strict thing is the 17. Before a qualified child dependent, we had the student. But child tax credit is very strict on the age. Okay? So it does have another item that the TCJA, new tax law brought in. And this is actually a credit for other dependents. So your parents or other children that finally make it past age 17, you get $500 for those. I know it's not $2,000, but hey, I go with 500 if you can get 500 just for having them still on. It's better than nothing. So they do call this like two parts, non-refundable and refundable. And non-refundable claims are actually a credit on line 12. And this is mostly going to cover any tax liability you have. And it will include the dependent credit also of 500. So it'll have the 2,000 plus additional 500, or depending on how many kids you have, it can have a lot. So the refundable credit we actually find out on form 8812. Now if we go on here to your book, it actually shows this form to us. Or you can go to IRS. This is this form right here called Additional Child Tax Credit. So that's a nice little form that we have. And again, the reason why some tax returns, we do need to know the substance behind it, but some of these become a little bit easier to read for them. Now, all we really would have to do is go through the lines, and of course if you go to IRS website, it's a little bit clearer. And again, it's just filling out the numbers and doing the math. So again, if y'all want videos of these, put a comment down. I will try and get through them as best as I can as we move out. But I want to get y'all the basics of what's going on. So the cool thing is TCJA made the 3 best adjustments that you could do, and it really increased the credit per child to that 2,000, and it also increased the threshold for more people to qualify and not be phased out, which is awesome. And it increased the refundable amount of credit for certain taxpayers. So really they're trying to get more people qualified that have kids. At the same time, if you're a higher wage earner, you don't need the benefit. So it's trying to limit the higher income but still be equal to everybody, because everybody can only qualify for 2,000 per child or 500 for dependents. So the credit again does phase out, and the thresholds for us for marrying and filing jointly is 400,000. As soon as our AGI goes above that limit, the credit slowly starts getting phased out, $50 per each $1,000 above that. For all the other statuses, single, married, filing separate, head of household, and qualified widower, it's a $200,000 threshold. So we have to watch out for that. We gotta see how much of adjusted gross income everybody makes, but it does help out. Again, this one does show the 500, and it does give a good example. Now this is an example that's going to be used in the next slide also, but this is using a married couple, Dante and Sharon, and they have a tax liability of $2,300 before any of our credits, and they are eligible for an education credit of $600 and a child tax credit of $2,000. Their AGI is $30,000. So the two non-refundable credits really do equal out to $2,600, which is greater than their tax liability, and so of $2,300. So the first thing that we have to do is basically take their tax liability and subtract out the education credit of 600. And we're going to get into education credits in just a bit, and that's going to equal out to that 1,700. And this just automatically goes 300 refundable, because after the 1,700, just take 2,000 from the child. So 2,000 minus 1,700 means we get a $300 refundable credit, because we basically already paid off our tax using these credits. So we get 300 back. Woohoo! Alright, so that's a little bit of what the process is doing. Okay, the next slide right here again brings out form 8812, which was this form right here, or if you're looking at your book, this very fuzzy form that they have here. Still the same. I would just, honestly, if you're looking at the book at these forms, just go to irs.gov and actually find the form. It makes it a lot clearer for your eyes instead of me just switching. But this is going to be called additional child tax credit. So there's another additional basically credit we can get, which is a refundable amount of $1,400 per qualified child, but it's limited. So yes, you get the child tax credit, and then you get the additional child tax credit. Yay, more money. So if less than pretty much plus 2 qualified children, which it's a really weird way of how they say it, the additional credit is lesser of unused child tax credit due to tax liability, or 15% of earned income over $2,500. Now, using the information we got before, $300 was their refund credit for Dante and Sharon. It is limited to 15% of earned income less $2,500, but not more than $1,400. Okay, so 30,000 minus 2,500 times 15% equals 4,125. Okay, so if this refundable credit, the 300, was actually more than what this was, we can only take, we're limited to that amount. But since it's less, which would have been pretty tough to get lesser than 300, but since our refundable credit is less, we get to take the whole $300 as refundable credit. Okay? Now, if somehow we have 3 or more qualified children, we can only be used to offset our FICA taxes. So, cannot be used to refund FICA. And FICA, again, is Social Security and Medicare. So the credit's limited to the greater of 15% of earned income over $2,500, or the amount of FICA paid up to unclaimed child tax credit. We don't really have much of that you'll see, but we do flow through. So again, I would always, for your problems and stuff, try to fill out these forms or print them out. And here it is, and this is where it's 3 or more, where we take the withheld Social Security, Medicare, and additional Medicare tax if we need it. We're going to put it in this box and basically enter the total amounts from Schedule 1, line 27, and plus any taxes you identify using code UT, which we're not going to deal with that. Again, there's a lot more stuff that goes in the tax that we're not even getting into. And then add and enter the larger of the lines 8 or line 13. Next, enter the smaller of line 5 or 14. So boom, boom, and this is your additional tax credit. So this is actually one that goes through pretty good. So that's pretty cool. Yeah. So we get additional stuff. Well, guess what? We'll probably have an example of this, right? Why not? Let's do it. So, child tax credit example. Let's see. What we're going to throw here. We have Kendra and Nguyen. Hopefully I pronounced that right. I think so. I know I'm talking to the PowerPoint going, did I pronounce your name right? No? Oh well. You're not talking back. But they're taxpayers with children ages 25, 10, and 3. And they all have valid Social Security numbers. And we'll get into that in a second about Social Security numbers. Their AGI is 432,200, and they file jointly. What is their child tax credit, assuming all of their children are qualified children? Okay. First off, check if they're over the threshold, which they are, because it was 400. So they're 32,200 over the threshold. So that's about 33,000 times 50. We're going to have some limits here. So let's look at this. Let's see how it pieces down. Right? So here we go. And I like how they go. Clearly, their tax liability greatly exceeds the amount of the non-refundable credits. Yeah, it's going to. But, so, AGI basically exceeds threshold. And this is how we figure it out. You can take 432,200 minus the 400,000 threshold and divide by 1,000. And we always round up. Sorry, that's how tax works. Yes, it's closer to 32,000, but since we're dealing with eliminations and reductions, we do round it up. So 33 times 50, because it's $50 per 1,000. We have a 1,650 reduction that's going to happen. So their child tax credit. Notice we have 2,000 times 2, because at most we can get 2,000 for the kids under 17. And their qualified children of 10 and 3 qualify for the $2,000. Well, that 25-year-old is well over 17, so he only qualifies for 500. So we take these two, 2,000 times 2, which is 4,000, plus 500, so 4,500, and then subtract this 1,650 reduction that we have, which equals out to 2,850 child tax credit, which isn't too bad. Still, I mean, it's not great, but hey, still got money coming off. So, of course, they're going to probably still owe tax because they're 400 and something thousand, but at least they get to take 2,850 off. Now, the child tax credit in itself does have some issues. Again, child tax credit is one of the most fraud next to our next one that we're going to talk about, the earned income credit. So there's going to be a lot of IRS coming after these. And this is why tax returns get delayed if they have either child tax or earned income. They wait because they're going to check these. So first thing, each child claim must have at least a TIN number, tax identification number, by the due date of return, which the due date of the return is April 15th. Still, but mostly before you turn in your return. Qualified dependents need not to have the Social Security number if credit is non-refundable. So if it covers the tax and nothing's coming back to the parents, they do not need to have the Social Security number, just a taxpayer identification number, or I-10 in some cases. But if there is a refund, we need some kind of identification number, and usually Social Security number helps out. Now, if the taxpayer erroneously claims child tax credit due to reckless or intentional discard, they will lose that ability to claim for 2 tax years. So, don't lie about it. That's the honest thing. If you lie about it and you do it recklessly or intentional, you can lose that claim for 2 years. Well, if it's truly built for fraud, this will extend to 10 years. And believe me, if they keep changing or if they raise it, being part of that 10-year where you can't claim it could actually hurt you a lot. Now, because of all the fraud, preparers must complete Form 8867. This is our due diligence checklist. So if you're going to become a tax preparer, all these tax credits that we're going over, we have to file this form. So just know the form, and it's basically really just a lot of questions we ask that they ask us to make sure that we've done our due diligence, are basically what a reasonable person would do to be able to claim these credits. And that's not bad. Again, it's just answering questions. Some of them line up to, did you ask if they are not allowed to take the credit? Did you reasonably get enough documentation? Are you retaining the documentation? So forth and so forth. And this again, refunds due to child tax credit will not be issued before February 15th to basically give the IRS some time. So this delays your refund if you're going to claim child tax credit, but still February 15th is not as bad as probably them delaying to like April 15th. So this is one. So this is the first one. So again, if you got questions, please put them in the comments below, and I will answer the way that they go. Okay, as fast as possible. The next credit that we're going to talk about is known as the Earned Income Credit. Okay, and are really probably the most fraud credit ever. I mean, this is what almost doomed Liberty Tax if it wasn't from the bailout from the government, because they did a lot of fraud on Earned Income Credit. Same thing with child tax credit. There was a lot. It wasn't the company itself, just a lot of their franchisees. And I will tell you this, tax pop-ups, if you go to one, watch out for this. Make sure you understand this credit, because this is the one that can cost you. So be careful. Okay, so let's explain what is the Earned Income Credit. First off, it is a refundable credit. So you can actually basically have a negative net income and receive this credit if you follow certain aspects. So, bonus. Nice stuff. But the problem that also runs in, it's only really there to attend to assist basically the working poor. It's again about income by reducing their tax burden. And again, can get a refund. You like that. Alright, so taxpayers with children can receive Earned Income Credit. So let's go to the book. And because it doesn't tell us the actual thresholds, let's see if we can pop it out. Here's the thresholds. Yay, thresholds! Okay, so again, always know these charts. These charts help out a lot. So qualified children, here's our thresholds. These are when the phase outs begin. If you have no children, phase out begins at 8,490. Phase out ends at 15,270. So if you make more than that, you don't get any income credit. Joint filers have till 20,950. One child, you can see it begins at 18,660 for 1, 2, or 3. So if you have a child, this is where your phase out begins. It ends at 40,320 for 1, 45,802 for 2, and then 49,194 for 3. Joint, just a little bit higher, not much. So this is stuff that we're going to look at. So if you ever thought that, hey, I could qualify, or here's the limits. Okay? The one filer that cannot claim earned income credit is marrying filing separate. Sorry. This is where they get you here. So if you really want to get the best credit, file jointly. All parties also must have a valid social security numbers, or at least identification numbers. They're going to come for this. They're going to ask. And foreign income exclusion is not allowed. So you cannot exclude your foreign income. So it's going to take that as part of your AGI. Okay? And you must be a U.S. citizen or resident for a whole entire year. So they're limiting as much as they can. Okay? And then of course earned income must meet certain guidelines. Again, they say it's in here. Here's all the guidelines. So again, AGI, social security numbers, marrying, filing separately not allowed, U.S. citizen or resident alien status is required, no foreign income exclusion, investment income limit, basically disqualified income, 3,500 in 2018, not much there. Earned income requirement, again, since it's for the working poor, and obviously requirement is that the taxpayer or spouse is to have earned income. So you can get it for self-employed after you report a Schedule SE and have earned income. So again, here's the examples where you can get earned income, maximum earned income for each one. None, max you can get 15,270, which we know that barely happens, so forth and so on. So we can, and then the book goes into some examples, but there is a few little things. Okay, so earned income credit with no qualified child. Now, as long as you meet all the qualifications are in the limits, you can still get earned income. But you also have an age limit. You have to be between the ages of 25 and 65 to get earned income. This is with no child. We'll get into other ones. Taxpayers cannot be eligible to be claimed as another taxpayer's dependent or be a qualified child of another taxpayer. Sorry, if you're a dependent, you're not getting EIC. And you must live in the U.S. for more than half of the tax year. That's all the limits are. That age limit sometimes gets people. So, one with a qualified child, taxpayers may get EIC with a qualified child with 2 exceptions to Chapter 1 definition. Child does not need to meet the support test. So you don't have to actually support half of the income. That's mostly because since it's working for the poor, you probably are under food stamps or any government assistance. Okay? but child must live in the U.S. home for more than half a year. So that does happen. Okay. Also, the child cannot be claimed by more than one person, and the taxpayer cannot be a qualified child of another taxpayer. Again, we'll fall into those lines, and we're still kind of stuck with the age limit. So that actually does kind of hurt a little bit. That age limit is bad. I'll tell you that because my sister, she's only 21, has my niece, and she can't qualify for this because she's 21. Believe me, we've tried. So, sometimes it's a little bit difficult, but it does move as we go. Okay? So, again, each child claim must have a taxpayer identification number, just like the child tax credit. If taxpayer erroneously claims again, due to that reckless, they lose ability again for 2 years. Again, probably about 10 if it's fraudulent. If the IRS rejects, though, for any other reason than a math or clerical error, the taxpayer must complete Form 8862 to claim EIC in a future year. So, let's see. Because, again, this one I don't think really pops up in the book very often, this form. But 8862, just in case you haven't seen it before. Let's see. This is our form to claim certain credits, and here's the earned income credit. So this is something that we would have to file if they go, and it does show there's the education credit, American Opportunity, and child tax credit. So this is our form if you get disallowed. Not the greatest, so don't get disallowed. So we'll zoom in. So as you can see, here's the earned income credit, and we have to file through all that. So sometimes tax returns get more complicated if the IRS does reject. Okay. Again, refunds are due by February. They start issuing them out by February 15th. Don't expect them before then. And again, we have to do our good old-fashioned 8867. So, as in counts. So, to calculate EIC, we usually use the EIC tables to calculate or ask IRS to figure for you on schedule EIC. Appendix B provides EIC. Compare the results to worksheet A. Take the small. So, this is the fun part. Let's go to the book. And the book doesn't really give us much to go with, except a couple of links. If it shows us the links, here's the link. So this is Appendix B if you use the book, the Earned Income Credit one. And it's a little bit, because I'm zoomed in. Let's see. So this is something that we're going to have to use to go through to actually find out. But the first thing to always go is to really make sure that they can file. So make sure they got the qualification limits. And then here's the fun table. Okay. Now I want to zoom in a little bit. So again, you're going to look for your credit. You're going to look for single, head of household, qualified widower, or married and filing jointly. You're going to look for how many kids you have. And then you're going to look for your actual income level. Okay? So, all the way up to the limits that you're allowed to take. And it will actually tell you if you have this kid, this is how much. Notice how the table right here for 0 has faded off as the higher we got. Again, that's our phase out limits. So, again, oops. Yeah, it's not going to let me actually scroll. But we got to find our lease, but list, then columns. Then you're going to have to go to the columns. Now you have your filing status. And basically from this worksheet, will tell you exactly your earned income. So again, it's a lot of fun stuff that we have to go through. So a lot of documents in themselves. So really what we're going to do is use that that basically table. So I would strongly encourage to basically grab that table for earned income in case we do have a math one and they don't provide it for you. And we're going to have a little bit of that. Again, basically the IRS tells us what our earned income credit is. So what's the difference about this credit is reported on 1040 compared to other credits? Since EIC is reported on page 2, it acts like a payment of tax, and therefore taxpayers can receive refund even if no tax is due. That's why this one is the most fraudulent credit, because again, you can receive a refund even if no tax is due. So if a taxpayer says, I guarantee you a refund, if they ever say guarantee, run away, because I wouldn't trust any of those that says guaranteed refund, because they're basically probably causing some kind of fraud with the EIC and you don't even know. Okay, so be careful of that. Alright, another tax credit again is the child and dependent care credit. This credit is actually pretty quick and pretty easy. This is for daycare, or basically any dependents that you actually have to provide care for. So this was to help working parents because daycare is expensive. And really it's for any dependent under age of 13 or spouse or dependent who can no longer take care of themselves. But if a child parents are divorced, child needs not be dependent. I like how the grammar is, but basically the child cannot be a dependent of the taxpayer claiming credit. Does not have to be the dependent. It usually is if she lived more than 50% of the year with the parent gets to claim it. But because the child care credit or dependent care can go to both parents because both pay, we can actually have a percentage to each one. That's a little interesting thing. We want to multiply the qualified care cost, which we're going to show in just a bit, by the applicable percentage based on AGI. And they usually range from 35 down to 20. Again, credit percentages are found on the first page of Form 2441. So, popping out IRS again, and 2441. So, again, if you go to the website, there's always the instructions. I would take a look at them. But here's Form 2441. And here is the table. So, this is our table. Yay! And this is what we will do. That is basically our AGI minus a little other numbers that they want to put in. Again, fun stuff going on here. So, our child dependent credit is determined by qualified expenses. We're going to look at how much expenses you've had in-home and out-of-home care. That includes having a person like a nurse coming in if a spouse couldn't take care of themselves, to basically any children. Day camps do qualify, but not overnight camps. Fortunately, no, cannot do an overnight. and the camp must be focused on fun and games, not education. I know, that's the fun part, but daycares really do provide a lot. And it's going to be limited to the lesser of earned income of lowest earning spouse. Okay? So, if one spouse doesn't work, well, you can't really go any lower than that. But it's also earned income. So, they have to earn income. So, if they don't work, they're not earning income, well, it's okay. But, you gotta make sure you make some money. Or, it's going to be $3,000 for one dependent or $6,000 for 2+ dependents. Again, it's going to take the lesser of. And it's reduced by any amounts reimbursed by employer. So if you got those fringe benefits that the employer gives you some money, yay. We also must include taxpayer ID, basically their EIN, Social Security, whatever they want to identify as them of who's given the caregiving. So, if a spouse is a full-time student, though, we count him or her as earning $250 per month or $500 per month with 2. So, that really drops it down. So, one of you is a student, that hurts. So, let's look at an example. Joanne has a salary of $58,400 and an investment income of $2,100. Now we all know investment income again is passive, so we're probably not going to focus on that. Lou, her spouse, is a full-time student of 12 months per year. Oh goody, he's a student. They have 3 children under 13 and total daycare cost of $12,800. What is their child independent care credit? How would this change if Lou is not a student and works part-time, earning $3,000, and Joanne receives $2,200 of employer-provided dependent care assistance? Okay, so they're throwing a couple of scenarios at us. So let's look how they calculate this. Alright, so qualified costs are lesser of 1. Her earned income of $58,400, or his earned income, which is basically $6,000, are imputed as $500 per month. Okay, so 500 times 12, yeah, that'll be about 6,000. Yay! So it does work out. So it's going to be the lesser of this, or annual daycare bill. Where our annual daycare bill is $12,800. Well, the lesser of the two happens to be $6,000. So we multiply by percentage from table on form 2441 based on AGI. So form 2441, basically anything above, over but not over, 43,000, no limit. Their AGI, basically adjusted gross income for her, is at least $58,400. So that's where we get the 20%. So we're using this table, we have to find it. So 6,000 times 20%, we get 1,200 credit for dependent care. Okay. Now, if Lou happens to work and Joanne receives assistance, qualified costs are lesser of such and such. Her income is $58,400. His earned income from the part-time job is $3,000. And this is totally, someone messed up on the PowerPoint from the book. Well, that's supposed to be annual, not Abdul. Abdul. Net daycare bill is $12,800 minus $2,200. Basically the amount that she got, so she received that, to $10,600. Again, $3,000 since this is the lowest of the spouses, is less than our daycare bill. And again, because she made this amount of AGI, basically AGI now is 58,400 plus 3,000, because he actually earned this. Here, he didn't really earn, it was student, but still, it's still high. So, again, that's going to hit that 20% from our form 2441. And that means 3,000 times 20% is 600 credit. So that's the child independent care credit. It needs a table. A lot of these need tables because that's just how it rolls. Next is one that's actually leaving us that the TCJA kind of removed, and this is the Affordable Care Act, the ACA. Now, the part that's being left from us is again the penalty that you get if you don't have health care. But if you do have to get health care from the government site, healthcare.org, you'll still get some credit, which is cool. We love that. Now, we call this a lot Obamacare. That's just how it is. I mean, believe me, whatever president would have done this, we just put their last name and put care by it. So, Bush care, Trump care, Clinton care. Clinton care doesn't sound right. Obamacare just has that ring to it. But anyway, basically 3.8% of net investment income tax and 0.9% of Medicare tax. Really, this is what's going to best the high income. This is part of the law that if you have this high income level, you are supposed to pay this extra Medicare. Well, there is certain exemptions to this. One, we can oppose for things like hardships. Our religion does not do health insurance, which there is some. Unaffordability, and there is a lot that goes on. And really, unaffordability was a big one. I mean, that's a good big exemption. The problem with these exemptions, though, they still have to be approved by IRS or by a government entity. Again, since this is really losing its teeth, because this whole thing, this is for the penalty, it's not being there. So ACA is leaving us after this year. 2019 right now is assumed that there will be no penalty. So this, we're not going to get too heavily involved. Again, we want to know what's going on, how to calculate certain things. So again, I would say look at the form 8965. I'm not going to look at, show you, but that's just where we report exemptions and what the exemption is. Some require exemption certificate from the health marketplace. So there's some things here. And this really just leads into two things: the individual share responsibility and the premium tax credit. So the individual share responsibility needs to show minimum essential coverage. Basically, this really just shows that you had insurance. You didn't have enough insurance, you paid the penalty. And basically, again, it's just to give the essential benefits, and we can purchase, again, through insurance companies, through our employer, from health insurance exchange. And again, we're not going to go too depthly into this because really it's not going to be there, and it's really just information. So health insurance companies, self-insured employers, insurance exchanges, etc., they're going to provide health, basically saying that you had health insurance by a 1095. If you receive a form 1095, you got it. And it really depends on the business. Usually 1095A is coming from the marketplace, where B and C come from employers. And if it's a C, it's a large employer. So they try and separate it out. Really, all it is information that we include on the tax return to show you meet this coverage and don't need penalty. If you don't have insurance, that's where we bring in the exemptions and want to bring in Form 8965, which there is a lot of exemptions. So, again, if we have the penalty, this is the penalty. So, individual share responsibility is calculated as an annual number, then divided by basically monthly. The MEC, our minimum essential coverage grader of AGI taxpayer threshold times 2.5%, or basically $6.95 per adult plus $347.50 per child, to a maximum of $2085. Now, the cap by national average and bronze premium on federal exchange was $3,396. So basically, if you had the bronze tier, you covered. The penalty is a pain in the butt, I'll tell you that. So really, if you don't have health insurance, you have a penalty, and it can be calculated up to this maximum. So it's really just kind of a thing that we have to get through. Again, after this year, 2018, 2019 does not have it. You don't have to worry about it. Now, if you did buy it off the marketplace, since the marketplace is outrageously expensive, some taxpayers may receive tax credits on the lower the cost of healthcare. And income eligibility is 400% of poverty level, wherever the government says poverty level is. Taxpayers below this level are eligible for Medicaid and not the credit. We use specific tables and other items. So again, the book will go into this. If we go find the premium tax credit, premium. There's the child dependent, allowable. And here it goes. So, premium tax credit, again, here's the list. Again, requirements, you must meet all. So health insurance is purchased through one of the state exchanges or federal. State of Texas does not have a state exchange, it's federal. Taxpayer is not eligible for coverage through an employer. So you can't reject the employer's coverage just to get this premium tax credit. Doesn't work. Taxpayer income falls below certain limits. Again, does not file married and filing separate. Taxpayer cannot be claimed as dependent. Okay, so there's a lot that relates to this, and really here's a little bit of threshold too. But one thing that we're worried about is really the penalty in itself and other things. Since this is more of a table, again, like other ones, we're probably going to look more at the form. So, it's a little bit of a wash. Okay? So, watch out when it comes to the quiz or homework when it relates to this. Premium tax credit, again, mostly know the qualifications, helps out a little bit more. Okay? Education tax credits. This is something we really have a lot of, but we're going to focus on a few. Basically, you're allowed to take a certain percentage of your education expenses, and it does become a credit. Now, it's really because it's supposed to take out the higher cost of education since it keeps growing. So the IRS, the government, decides we're going to give you some credits to go to school. And this chart right here just basically says that throughout this book, these have been popping up like crazy. Like Chapter 2, Chapter 3, Chapter 5, that's the student loan interest deduction we went through. More Chapter 2. So some of these we've already gone through. Chapter 7, which we're in now, brings in the two biggest ones. The ones that we actually know more about. And the first big one is the American Opportunity Tax Credit, or the AOTC. And this provides tax relief for qualified higher education expenses. And basically there's a good list. And so that's a little thing. Let's see if I can find the list. And there we go. So tuition, course-related books, course-related supplies, notice room and board, it's not really part of it. Transportation, stuff like that is not part. They're usually part of other credits. So this little chart right here does show you we're mostly focused on the lifetime learners credit and the AOTC. So they're going to affect most of those. The rest of these can actually help with determining costs, especially with scholarships that give us extra money. So with this, we have, again, Form 8863, which you already know the drill. Here I go looking it up. So 8863. So this is our form for Form 8863 on basically the two education credits. And again, this is mostly, we're going to take in a lot. We're going first, we got to get into the institution, which college. Going to check off if you got a 1098-T, which you should have, because everybody gets the 1098-T when you pay to a college. And we're going to run through the numbers. So this is finding all the little education items. So to be eligible for this, I mean, it can be a taxpayer, spouse, or dependent, and it's got to be in the first 4 years of college. So basically before you get your bachelor's. Okay, they extend it, but 4 years of college, and you're pursuing a degree or a credential, basically your bachelor's, your associates, anything within that 4 years. You have to at least attend half-time for 1 term, determined during the tax season. So as long as you are there for at least half the year, you're good to go. Can't have any felonies or drugs. And again, you gotta have a Form 1098-T that comes from the college. If you know you went to school and you did not receive this form, request this form. Helps out. Now, the credit does equal 100% of first $2,000 plus 25% of the next $2,000. So your maximum credit for the American Opportunity is $2,500. Again, AGI has to hit us. So let me see if it does show us the AGI. Go away. Alright. Okay. So let me see. AGI. Okay, it's not really giving me a, but usually it's the same. So the AGI is limited. Again, there's a phase out. Here we go. There's a phase out. For 2018, phase out joint filing returns with income between 160 to 180, and for single and so forth, it's between 80,000 and 90,000. Alright. So we do have certain limits, and then 40% of it is refundable. And of course, we have to apply our 8867 as a tax preparer. Okay? So a little bit of what the American Opportunity is. Now, lifetime learning credit. This does provide tax relief on education expenses and does encourage taxpayers to take courses to acquire or improve job skills. Again, you're there for some kind of certificate. This really only provides on tuition and fees only, not books, but still subjected to some of it, and can be used for less than a half-time attendance. Again, this is just you going to try and get some more skills. Of course, you can't have drugs, can't be in jail, or you won't get the credit. And this is going to be calculated on form 8863, same form here. And it's going to be a credit equal to 20% of the first 10,000. So basically our maximum credit is 2,000 per year. And it does have lower AG phase out, so again, our adjusted gross income phase outs are a little bit lesser than the American Opportunity credit, but may take credit in relation to undergrad, graduate, or professional courses. So we can have both of these credits go after each other, and usually we take the best of the two. There is no limit though. You can claim the lifetime learning credit till the day you die. You can always claim this. You can always get it as long as you get those forms of 1098-T. So, limitations between our education. For each student, taxpayers can get only one of the credits. Again, either LLC or AOTC. And we could take one of each for different students. It's just limited to that student. So one student could take LLC, the other one could take AOTC on the same tax return. They just cannot take both. Only the person claiming the dependency exemption can claim the credit. So when a parent files for a student, they get the credit. So it does hurt a little bit with those AGI limitations. And you cannot claim for any sports, games, and hobbies unless the course is part of the degree program. So that brings a little bit harder for athletes, but again, they're in a course degree program that allows them to have it. And must reduce expenses by tax-free scholarships or employee reimbursements. So again, we have a little reductions. So let's see what the education credit example is. So we got Dave and Val. Again, married and filing jointly, because filing separate totally misses the boat. They have 2 dependent children and have an AGI of 72,000. Okay. Sean is taking 4 credits, part-time enrollment at City College of Newark. His tuition and fees are about $4,200, and then Corey is a freshman at Tulane. Her tuition and fees are $39,200. Seems about right for Tulane. Neither child has any felony drug convictions, because if they did, they will have a chunklet thrown at them for being bad. Okay, what amounts may Dave and Val claim as education credits? So, let's look at this. Alright, and I apologize. Let me see if I can raise this up just a little bit. Here we go. Hopefully it's not too fuzzy. Alright, so here we go. So Val and Dave may take 3,340 in total education. Okay, their AGI is below the phase-out limits for both credits, so they get the full amount. Again, we have to actually go look up the actual credits. Here, married and filing jointly, below 160, we're good. Lifetime learning, right here, income between 1 114,000 and 134, and there's the single. Okay, so those are the ones you really just want to highlight or write down, those limits. But since they're both under, it says we get 3,340. Didn't really explain much, did it? Well, here's the explanation. So Sean may not take the AOTC because he's not enrolled in half-time. He's really not. He's only enrolled in part-time, only 4 credits. Didn't really get into half-time. Okay? So, therefore, he's only allowed to take that 20% of 4,200. Okay? So, because that's the lifetime LLC. So, he gets $840 credit. While Corey, she gets the AOTC because, one, she's a full-time student. She gets 100% of 2,000 plus 25% of the next 2,000, or 2,500 of the AOTC. Add those together, and that's where we get the 3,340. Okay, so that's the big credits that we have, plus another one that got added on. But the next credits that we go through are like a little bit simpler credits. First off is the foreign tax credit, and this is for people that live abroad, because guess what, US wants tax even if you made it across the sea. So US taxpayers are allowed foreign tax credit on income earned in foreign countries and subject to income taxes in that country. If you're not subject to income tax in that country, well, guess what? It's coming to the US. So mostly seen on dividends of foreign stock, and it's reported on Form 1116. Again, usually very small withholding. If you have any of that, you don't need the form, but we can carry it back for 1 year or for 10 years on the credit. Or not. This one is a little bit more for a more advanced tax course. So again, this is just information just to help out and get you the basics of what this form is, or this credit. So its main goal is to keep you from double taxation from foreign sources. The maximum credit is the amount paid to foreign governments, but limited to your net foreign income divided by what you made in America times by your tax liability before credit. I know, fun stuff. But we're going to give you this information. So, Joe Still had 200,000 income from U.S. and 100,000 income from employment in Lithuania. Oh, I can't say it now. But he paid 40,000 in taxes in the foreign country. Assume his U.S. tax liability is 85,069. What is his tax credit? Well, max is going to be the 40,000. So this is how it's computed. His maximum is the 40,000 paid, but it's limit to the 100,000 in the foreign country divided by basically his total income, so 200 plus 100, so 300,000 times 85,069, which gives us a good old credit of 28,356. That's what we're limited to. So what about this remaining amount? Well, this 11,644, which is 40,000 minus the credit, can be carried back 1 year if we wanted to help if there's taxes owed, or it's going to move forward 10 years as the unused portion, and this can actually grow. It can grow very big, but this is in case we need a little extra help with the tax credit with foreign income. Mostly, I'll be honest, it ends up using just that 1 year and then it never gets used again. To be honest, even with its carrying forward. Sometimes it's really difficult unless something just happens. Okay? So, Next is the adoption credit. So we went through the foreign tax. Here's another small one. The adoption credit in itself is to help people to actually adopt kids, to help get foster children. So we do provide the credit who pay adoption expenses and are married and filing jointly. So have to be married and filing jointly for this one. And the credits is an amount spent up to $13,810 per adoption and has that phase out starting at $207,000. Different rules are paid for expense over more than 1 year if it's a foreign adoption, and qualified expenses do include court costs, legal fees, travel, and anything else. And we're allowed to use the credit for up to 5 years. This is going to be calculated on Form 8839, but again, this one is one of those lower credits, so more information based for y'all than a lot of calculations. So employer provided can actually help with adoption, and this is if employer pays qualified adoption expenses. We have to exclude these amounts paid by employer, must incur under the assistance program, and taxpayers may claim adoption credit and adoption exclusions for same adoptions, but cannot claim both credit and exclusion for the same expenses. Okay. The total amount excluded per child is limited to $13,810, and it's subject to phase out. Okay, so we do have some adoption stuff that helps out. Now another little thing that we do get is energy credits. So we did the major ones, now we'll get into some of the small ones. But energy credits is one that really just comes and goes with Congress. Okay, Congress had a bunch, but some of them have already expired that we don't even deal with anymore. But it's good to know. And this IRC section, this is the Internal Revenue Code. And basically, if you look at these sections, you'll find it. Out of the 5 that were started up, 3 of them have expired in 17, and only 2 remain active. And that's the electric vehicle and the residential energy efficient property, the REAP. Reaping very good. So what are these? Well, electric vehicle credit is credit for purchase of a hybrid vehicle, and the amounts vary based on a combination of weight and kilowatt hour of traction battery capacity. And usually you're going to get a credit between $2,500 and $7,500 for buying an electric vehicle. And this is a hybrid, not truly electric, not truly gas, hybrid. Okay? Credit phase out for each car manufacturer when they hit 200,000 cars sold. So this really comes a strange thing. Not very many people take this because they do hit 200,000 cars sold already for most, but this is still allowed for the Chevy Volt, the Nissan Leaf, the Hyundai Clarity, and other electronic vehicles. This is something that we would actually have to look at the IRS to see if that vehicle has hit the phase out limit. So Priuses, they are well over 200,000 now. So I don't think a Prius qualifies anymore. And again, that's something we would actually have to discuss with the IRS. Now, the residential energy efficient property credit. This is a credit for alternative energy expenditures installed at your primary or secondary residency. So at your house or vacation home or something like that. And this is basically a 30% credit for installation of solar, wind, or ground source geothermal heat pumps. And they reduced to 26% for property placed in service starting 2020, and again reduced in 2021. You cannot get this credit for a heated swimming pool or hot tub. Don't try it. Won't happen. And basically, it's just really there to get you to do renewable sources to help out your energy companies. And we report this on 5695. Not really much that we're going to go through on this again. And then other credits that we can have. And there is so much more, but elderly disability credit, a disabled access credit, general business credit, small employer health insurance credit, research activities, work opportunity. There's so many others. There's so much we just don't have time to get to. And the book really doesn't want to get into all of these, but this is a good research task if you would like to go through these credits. So really, that's it for chapter 7. Hopefully you learned something. If you have any questions, put in the comments below and we'll get back to you. Okay? Y'all have a good one. This is Professor Naragon signing off.